Hey, Jerome, great to see you here. And how are you feeling right now about the bond market?
Good afternoon. And we're feeling quite positive about the bond market. You know, there's a certain sense of rationality to what we've witnessed over the past few trading sessions with the bond auctions, with the understanding of where risk appetite is going. We've had a lot of the volatility taken out of the market, both from a Federal Reserve, a monetary policy perspective, as well as a risk appetite perspective. And it's not necessarily a go away in May and manage your risk accordingly, but it's one where people are slowly beginning to adapt to a higher interest rate environment. And in that construct, that higher interest rate environment fundamentally means that you're going to have to accept higher, bigger, longer bond auctions, accept a term premium moving from negative term premiums, meaning the amount you pay further out the curve, to something more rational. And what we're simply witnessing over the past few sessions, number one, is a slow but methodical process to understand what that term premium should be. But also, we've done pretty much a round trip in terms of yields over the past month, specifically in the front end. And so putting a context around this discussion, perhaps it's simply that the Federal Reserve has a much steadier hand in expecting the outcome than the market at this point in time. So the market's probably more data dependent simply than the Fed.
Okay, Jay Powell thanks you for that compliment because I think he's been looking for some sort of affirmation for a while. I do want to get your knee-jerk reaction, though, to the auctions that we've had this week. And I know 3 auctions in 2 days doesn't necessarily make a trend here. Right. But when you consider how tepid some of the demand has been, is that a harbinger of more to come? Or is this just kind of that wait and see until we get more movement by the Fed, or at least more communication by the Fed, people will feel more comfortable with some of these durations?
Perhaps it's simply just a recalibration, not necessarily only of supply, but the triumvirate of outcomes: growth, inflation, as well as supply. And if you think that the inflation prognostics are going to be a little bit longer, then perhaps you actually want a little bit more term premium out the curve. And then when you combine that with where risk appetite is, with tight credit spreads, relatively speaking, equity risk premiums, obviously, in the higher echelons of historical realms, this puts you into a situation where a rationalization of what you should be paid both in nominal terms and real terms should be probably a little bit higher than we are today. But that being said, again, going back to the focus on volatility within the broader marketplace, when you look at where fixed income is today, and when you see where the 10-year note and the 2-year note is at this point in time, from a real return perspective, and a forward-looking real return perspective where you have the 5-year forward rate expectations still above 2% at this point in time, fixed income actually offers a really compelling opportunity over the secular horizon. And taking that into context with regard to that we're probably going to have a little bit more volatility within the broader marketplace over that same time frame means that you should probably be allocating a little bit more to those income-producing assets as opposed to banking on capital appreciation.
And where is the risk-free rate in that? Like, it used to be the 10-year. Is it still?
Not necessarily that the 10-year is the risk-free rate per se, and honestly, the market is very bifurcated in that. If you're a real estate investor, the 10-year note is going to be very focused. But really what people are focusing on is the overall rate regime moving from 0 or near 0 interest rates and globally to a higher interest rate environment. That simply means that we have to be thinking about what the expected returns are across all asset classes at this point in time. So this rationalization, what we're looking at the microscopic view of 3 auctions and saying, oh, here's the beginning of a trend, it might be, but the reality is that the calibration toward where we are headed has more to do with the digestion of high real rates and high relative rates here in the near term versus what we've been accustomed to over the past 5 to 10 years. And that's going to take some time in order to avoid indigestion. And frankly, this is, again, a very rational expectation for the market to be having at this point in time.
Just basically means that what I'm hearing is it's just going to be range bound. And it might be a wide range, right? But it is going to be range bound. We're going to see some volatility around there. What's the best way to play that?
So that's exactly right, is that there will be probably more volatility in a relative sense than we've been accustomed to in the past, simply because the Federal Reserve is sitting a bit back and sort of assessing the landscape for inflation a little bit longer than the market had expected. But in that context, what it simply means is you want to be weighing and leaning into asset classes that are going to have a little bit more resiliency, high-quality asset-backed securities, even stepping out of those cash domains that people have found for a very long point in time as attractive, because we know we're going to be at this higher rate environment for a longer period of time, begin to sequence out of your traditional cash products like Treasury bills and move into the front end of the yield curve to get those 6 to 7% returns in those high quality assets.
Why do you think people are so reticent to do that right now?
Well, number one, originally it was because they were expecting rate cuts along the way.
Yeah.
Secondly, when they think about risk taking, there's still a relative concern about where are we in the cycle? Where is risk taking going to land? Is it a hard landing? Is it a no landing situation? And I think really what fixed income offers is sort of a look through to get to the other side without being very decisive about what that landing zone is. So contextualizing, higher rates are probably here for longer, we believe that. Mm-hmm. And at the same time, while there may not necessarily be a rate hike on this in the near term, the reality is rate cuts probably are pushed out a little bit further. So contextualize your allocations to adapt to and embrace those higher income derivatives in those sense and move to fixed income in that guise. And so it provides a smoother landing compared to a smoother landing zone compared to the equity returns.
Yeah.
And frankly, removes that uncertainty or effectively the need to bet on a growth outcome over the secular horizon.
This may be a dumb question, but for those folks who are trying to count on rate cuts at some point in the future here, everyone's looking right now at that 2% target and saying that until the Fed gets there or close enough to it, we're not going to see those cuts. You know, there's also a big argument out there that the Fed may actually be willing. They may not want to say it out loud, but they may be willing to accept the fact that we're going to be above 2%,
right,
and they can live with that.
Well, you're going to get a hint of that in the June summary of economic projections, the dots, if you will, and it's probably going to put the PCE at a little bit higher number, closer to 3% than the previous dots back in March. So that's your first hint of where the Fed thinks longer-term inflation is going to head. Secondly, there might be a discussion being more formal or informal discussion being had at Jackson Hole in later summer, and that's a great forum for them to begin to plant some seeds, see where that ends, so that maybe the R star, the neutral rate, isn't as low, which, while quantitative and sort of wonky to think about from an economist's point of view, from a practical point of view, if I just said to you, hey, inflation's going to be higher over the next 10 years than you thought it was going to be in the past, your expectations of return should be very, very different. And when you do that analysis, whether you're a retail investor or an institutional investor, you begin to want to gravitate toward those asset classes that are producing real inflation-adjusted returns after the fact. And that's where fixed income becomes that focal point over that horizon. So that's a very real conversation and not a dumb question. It's something that investors should be focusing on in that longer-term discussion.